Hi, I'm Mark Schiele. I'm the Chief Executive of Oyster. It's good to have this opportunity to update our investors. It's also great to be back in the office again. From where I sit, our properties are incredibly well placed to continue to provide our investors with the returns that they require, and our team is very focused on ensuring that that happens. So our feeling around the whole COVID experience for New Zealand is we clearly have dealt with it well from a health perspective. To do that, New Zealand has made an incredible sacrifice. Level 4 was a very, very big call for the government to make and for all businesses to make. And where we've ended up is quite a difficult position. Everyone will have seen the job losses that are occurring through the media. Everyone will have seen the wage cuts and the issues that are flowing through from there. So there's been a number of initiatives put in place to help protect New Zealanders, the wage subsidy being probably the key one, and that's helped a lot of businesses, particularly hospitality and retail businesses, stay afloat through an absolute reduction in revenue through lockdown. But there is uncertainty on the horizon still. It's incredibly heartening to see people walking into stores, retail stores, and flowing out of office buildings now, but the impact is significant. We will have and we have unemployment growing, and that means that there's going to be a lot more focus on where people are getting their revenue from, and the tax system itself is going to be burdened a lot by the money that's been dished out to protect us through this process. I'm confident with where Oyster is today. I'm confident with our properties. They're well located, they're quality buildings. We've got occupiers that are paying rent currently. We believe we've got buildings that will attract occupiers that can pay the rent in the future, and that provides quality returns to our investors. Relative to other asset classes, relative to other investment opportunities currently, we believe, even more so than in the last few years, that commercial property provides appropriate risk-adjusted returns for our investors. If you are looking at bank deposits, fixed term interest rates of any sort, bonds, coupons or the like, you're looking at probably sub 2% in the current marketplace, and you are getting those returns on a, at best, quarterly if not 6-monthly basis. The risk attached to commercial property returns is appropriately priced when you're looking at returns within our funds of anywhere between 5 and 6%, say. So I think with the Reserve Bank focusing on potential of negative interest rates going forward, now that's not necessarily going to affect depositors, but it's certainly giving a clear signal that interest rates are going to be lower for longer. There are a number of investors, and our investors are no different, that are looking for returns on their capital, and they understand the risks associated with commercial property. From our perspective, even through these times, you are always left with land and buildings, and if you have appropriately located property, the ability to find a tenant, even if that occupier who was there is no longer there, the ability to find a tenant is something that we're confident in. So we see commercial property as, clearly we're conflicted, it's our game, but we see commercial property as something that is probably more appealing now when you are looking for yield than it has been over perhaps the last 5 years or so. So Oyster's focus on continuing to deliver value to our investors is really around understanding who the best occupier is for the space within our properties. We'll be buying more property going forward, but in this environment there's clearly uncertainty around how people are going to make revenue and how people are going to pay bills. We're very focused on ensuring that our tenants make it through, our occupiers make it through. Look, the challenges for Oyster moving forward are understanding which occupiers to choose to lease space, what our existing occupiers' outlooks are moving forward, Are the industries that they operate in impacted by what has gone on? Will they continue to be impacted? So within our existing portfolio of properties, we need to ensure that we are comfortable that we have the right occupiers paying rent moving forward, making sure that the properties themselves are relevant, that we continue to treat those properties appropriately from a perspective of capital expenditure, from maintenance perspective. In terms of new properties moving forward, I think we have some challenges ahead of us understanding where the retail environment in particular is going to land. To be fair, we went through into COVID-19 very quickly. Oyster went into COVID-19 raising equity on 3 projects. We settled 2 of them in the heart of lockdown, and both on the same day, which is unprecedented from our perspective. We did not move forward with a retail property that we were looking to purchase, and we did that specifically because of the challenges of COVID. We did not know at the point in time that we were due to move forward on that property when the occupiers in that property would be able to open for business. That created incredible uncertainty for us in forecasting what rental streams would be received and whether those occupiers would actually make it through. Nobody knew how long we were going to be in lockdown for. It's been fortunate that it has been shorter than many had predicted, but it has still impacted a lot of retail occupiers. So I think the retail category generally, there's a question mark around in terms of how shopping centres in particular will evolve out of this. The areas that have been hardest hit, hospitality and in particular, were a growing and are a growing part of any shopping centre environment. So understanding who those occupiers are going to be moving forward, what the basis of their occupancy is going to be, can they afford to pay rent, is a tricky thing for all property owners. Currently, we operate in 3 sectors: office, industrial and retail. We have properties in all of those sectors. We purchase properties in 5 geographies, and we're very, very clear on those 5 geographies: Auckland, Hamilton, Tauranga, Wellington and Christchurch. We haven't gone broader than that. We don't intend to go broader than that in terms of the provinces, fundamentally because we seek enduring occupier demand. And this is irrespective of COVID. We didn't know there was going to be a global pandemic. I don't think many people did. But through that shock and through any other shock that we may have had, we are in a position where we still believe that there is enduring occupier demand in those 5 cities, in those 3 asset classes that I spoke about. The enduring occupier demand means that at the end of anyone's lease, we believe that we can release that premises for about the same rent, if not more, than is currently being paid. If we don't believe that, then we probably don't buy those properties. So that is, I guess, the way in which we've always operated. If you overlay COVID-19 and the challenges of that, are we still as convicted on those things? Yeah, absolutely. There are massive changes that will occur in some sectors and have been occurring in some sectors, but fundamentally there are leases that have rent being paid, and we've worked with many of our occupiers through this process to ensure that they can get through. We have become part of the solution for them. Sometimes we've abated rent for a period of time, sometimes we've deferred rent for a period of time, sometimes we've negotiated longer terms in exchange for rental relief, and that just it's a bespoke basis, and it's a case-by-case scenario that works for the occupier. I suppose our asset management team in particular have been doing an awful lot of work understanding our occupiers' businesses, understanding what their outlook looks like under COVID-19. Do they have revenue that is going to continue? Do they have reduced revenue? Are they in a sector that is incredibly impacted by it? Those sectors would be tourism, hospitality in particular. But retail, obviously, through the closures that were required under level 4 and level 3 are also have also been affected. And so we need to understand what our occupiers are doing and what their outlook looks like to make the best decisions going forward for our properties. There have been various murmurings around what is the future of office post a global pandemic, with everyone having to work from home and remotely for a period of time. I suppose our view is very much that humans are social creatures and we need to connect with each other. We've seen an incredible experiment through COVID-19 where people were working remotely and were operating on screens and engaging through Zoom meetings. It worked as well as it could in the environment. Our experience and those that we have spoken to is that there is fatigue in terms of that environment, is that you don't get the energy that you need from your co-workers in that environment on a regular basis. Certainly works for some sectors better than others. What we don't see is that there is going to be a mass transition to remote working and that office will be dead. That we do not believe that that's the case. In our own case, we are developing a more flexible working policy, which may mean change in start times, the ability to operate from a project-to-project basis outside of the office. But we will still have the office as our base. We will still have that as the way in which we connect our people. Many of the businesses I've spoken to are in the same boat. Clearly there are leases in place too, so from the perspective of occupiers, they have a requirement to pay rent, so they will. The other end of the spectrum, of course, is that the health concerns that have come out of COVID, such that the co-working environments, the hot desking trends that had been occurring for the better part of 10 years now have stumbled. People are less comfortable sharing a desk with many unknown people in the current environment. People are less comfortable being tightly crammed into an office environment. So we have seen progressively the area per square metre per employee coming down in an office environment. It's unlikely that reduction will continue. In fact, we believe it's going to move the other way. So office environments are going to be slightly more spacious and than they were previously. So on one end of the spectrum, you've got the catch cry that everyone's going to work from home. The other end is, well, we actually need a little bit more space per person within the office. Now, somewhere in the middle, we believe we'll get a landing, but it is not going to be the death of the office from our perspective. The sort of office space that we have traditionally purchased and that we are looking for in the future is that provides amenity to those that are occupying it. So good transport systems, good transport links, close to public transport, close to motorway amenity. Parking, where provided, is easy. And obviously there's another school of thought that public transport may be less utilised in a more health conscious post-COVID environment. Looking at some of the motorway systems, since we've come down through the levels, I wouldn't necessarily subscribe to that. I think public transport is going to need to play its part moving forward, and as people get more and more comfortable, that will occur. So amenity, space, outlook, proximity to food and entertainment and essential services is pretty important. Whether that's in a business park environment or whether it's in a CBD environment, and if it's and they all have their own requirements. But that's the sort of property we've purchased previously, and that's the sort of purchase we will make in the future. I've been with Oyster, and in fact the entity that merged was part of the merger to create what is Oyster now for 23 years. We started a business in the late 90s that was a commercial property business that developed and partnered with global capital. In 2010, we purchased a small syndicator and we merged the two businesses and created Oyster as it exists now. What makes me most proud of Oyster is that long history of serving investors, whether they're global capital investors or whether they're public investors, well, and the growth that we have had in particularly our public investor numbers. When we bought the first small syndicator in 2010, I think we had 300, 400 investors. We now have nearly 1,800 investors. We have 800 investors in our diversified fund, in our direct property fund, which is diversified across about 700 million in commercial property assets. The growth that we've seen in our portfolio from originally 500 million in 2010 through to nearly 2 billion currently is testament to the team here. It's testament to our investors who support us on the way through. Clearly we wouldn't be buying property if we didn't have investment support. Oyster has many investors that have been investing for, I would say, close to 20 years and are invested in a number of our funds. We continue to see support from those investors across a broad range of the properties that we purchase. What's really heartening to me is when we see investors who we haven't had invest in more recent funds invest again, and often that's because of their own convictions. They like multi-tenanted office towers, but they don't like single-tenanted industrial. They like the alternate. They like a certain geography, and that's incredibly heartening because they obviously are parochial in their own thoughts and they understand property to the extent that they know what appeals to them. I am an Oyster investor, so I invest in a number of our funds. What makes me confident about the returns moving forward is the need for appropriately located property, all the things that we look for against a backdrop of an environment of lower for longer interest rates, lower for longer alternatives, against the backdrop of a volatile share market or potentially volatile share market. The fact that I get paid my return on a monthly basis, on a regular basis, that I do not have an hourly update on sentiment-based value for my property, which is essentially what happens in the share market. We value our properties annually, and we have, as a consequence, relative stability. They clearly will go up and down through cycles, but we are not being told annually just because of some fright in the market that our capital has reduced by 75% or reduced by 25%. So the sorts of things that give me comfort as an Oyster investor is that my capital is preserved. We spoke earlier around what is important to investors, capital preservation, and that I get regular monthly returns, and that's due to the quality of our occupiers and the fact that we are working very, very hard to ensure that our space is fully leased. The year ahead is going to be challenging for all sectors, for all parts of the economy, for many people within the economy. There will be job losses, sadly. There will be business failures, sadly. There will, however, be opportunities, and there will be some really interesting opportunities for New Zealand that come from the health gains that we have made and the sacrifices that we have made. I think there's a lot of opportunity, there's a lot of challenges, but from our perspective, we believe in the properties that we've invested in, we believe in the occupiers we've got within those properties, and we are really working hard to ensure that they can continue to survive. Priorities for Oyster over the next 12 months are to focus on our occupiers. Our asset management team are very, very deep in an understanding of every one of our tenants' businesses to try and understand what their prognosis is, how can they continue to survive. If they can't continue to survive, what the opportunities are for us to release their space to provide the best possible outcome to our investors. We're very confident about our ability to source quality property. I think there'll be some great opportunities coming in the next 12 months, and we definitely intend to be offering new investments to our investors. Additionally, on an ongoing basis, we provide investment into our direct property fund for all investors on a monthly basis. Any investor that wants to know more about their investment in Oyster, or any potential investor that wants to invest with Oyster, should be reaching out to our investor relations team. They're constantly talking to our investors, they're constantly updating them on the state of play with their investments and with the assets that we hold. Yeah, Oyster's very aware of the challenges. We've been through a difficult 3 months. We're absolutely rapt to be in the position that we are in today moving forward. We're confident of our ability to continue to manage the assets in the face of the future headwinds, and there will be future headwinds, but also confident in the properties themselves to produce good returns for our investors. So the two things that our investors are looking for is capital preservation and regular returns, and we see that unlisted commercial property continues to provide those. In the coming year, we, Oyster, its team, are going to be working very hard to ensure the quality of income that comes through our properties, the rent that's paid from the tenants, is such that we can continue delivering those monthly returns to our investors.